Good morning, everybody. So for those of you who were here yesterday, I moderated a panel on digital assets, but that panel really focused a lot more on the market structure, the regulatory environment, in just the landscape of what's available in the world and how we were progressing in adoption for digital assets. This panel on digital assets is really drilling down a little more towards our asset management space and how do we feel about how it fits into the broader portfolio? How should we be using it? What are some of the risks associated with it that might be different from the other things that are in our normal portfolio? So let's dive in there. But first, I want to just make a few introductions for those of you who weren't here yesterday. My name is Tony Tuths. I'm a partner at KPMG, and I lead our digital assets group. So that's leading everything from the actual devcos who are designing the new L1, L2s, and the other financial products that are forming the infrastructure of digital assets and blockchain as a whole. And of course, the big VC funds and hedge funds that invest into the space, all the way out to our Fortune 250 companies who are starting to use digital assets in their own business model. So let's introduce our panel. If you want to start.
Hi, Eric Pollackov. I head up our capital markets, our ETF business in the United States at Invesco.
Kelly, Deputy CIO, Avenir Group. We are a crypto native family office.
Hi, Robert Materazzi. I'm a venture partner at Blockcelerate Venture Capital.
Frances Newton, and I do wealth management at Scarlet Oak Financial, and also I do a lot of consulting for UN entities and consulates and governments about public policy.
Hi, everyone. I'm Matt Kunke. I'm a crypto product strategist at BlackRock, so I do all our client engagement for IBIT and ETH, our crypto ETPs.
Awesome. So we've got a really esteemed group across the spectrum of asset management. So let's just dive in with I guess the question most people normally have about digital assets when they're not like totally digital native, which is, I have a normal portfolio. My financial advisor manages it. Stocks, bonds, things of that nature, mutual funds, ETFs. Kelly, from where you sit, so where do you see digital assets fixing in with your model portfolio, and how should people be using them in their investment?
Sure. When you think about digital asset, it's not really just one thing, right? There's Bitcoin, which hopefully everyone know by now, and then there's everything else, right? I think when you think about portfolio allocation, you also have to differentiate Bitcoin versus everything else. For Bitcoin, it's been 17 years. We have iShares here with IBIT ETF exceeding total AUM of 100 billion. I view it more as alternative storage of value because it's really the oldest blockchain that's battle tested, and it's really establishing a consensus mechanism without an intermediary of trust, right? So, and as years go by, it has evolved from emerging technology asset with 100 vol into now a 40 vol or even lower asset, right? And then a lot of our clients are thinking about Bitcoin really as alternative storage of value, a hedge of monitoring inflation, or people use digital gold. And this is how you think about portfolio allocation in terms of a hedge for global inflation. And for everything else, you probably heard of Ethereum or Solana. Those are still technology that enables smart contract and enables people to conduct business, again, without intermediaries. It's really setting the foundation of a future economy that is more empowering peer-to-peer transactions. I would say it's still in the early stage, right? And those type of either blockchain-related tokens or applications building on top of them, I still view them as early-stage technology and fits into the growth bucket.
Great, thanks. And of course, there's a lot of ways that we can invest into digital assets. I mean, we can obviously invest into spot tokens through a wallet. We have some exchange-traded products. We have futures and derivatives that we can invest in today. So, Matt, with respect to like exchange-traded products, how do you see those working in the portfolio construction?
Yeah, I mean, I think when we're talking about the ETPs, like the asset allocation decision, investment decision is still the exact same thing that Kelly just alluded to. It's the core investment case for Bitcoin. They're just wrappers around Bitcoin, wrappers around ETH, and they make it very efficient for traditional investors that may have challenges going to Coinbase or going to some digital asset exchange they don't have a relationship to purchase. And so I think it's very much just an access story. And it's a story of efficiency. Even people like myself who come from a very crypto native world have a good deal of Bitcoin on separate like self-custodial wallets, on exchanges. If you think about though, even that process, like it's still just a very expensive proposition to go buy Bitcoin spot on Coinbase or something like that. And so now you just have a wrap basket of Bitcoin with the institutional standard around it, with best in class outsourced custody, trades at a basis point wide in terms of spreads. It's the same exact Bitcoin investment considerations, but just an easy, efficient vehicle that abstracts the user away from all the operational complexities of blockchains, private keys, etc.
I would just also add, I mean, I think with the 33 Act protections that investors now have in the ETP format, you also have things like the order protection rule, right? Best execution when you go to buy it, like where you don't have that at Coinbase, right? If you're going to buy individual Bitcoins and have a self-custodial wallet, you don't have protections that you do have in the ETP. So again, to Matt's point, it clearly is much more efficient, and you also get protections that you don't get in just a native wallet.
So I usually, just to comment on that, that you consider it more about comfort than access, honestly. For all those reasons, I have a Coinbase account. I've had one for a while. You can sign up for a Coinbase account in minutes. It's very easy. So it's clearly accessible to anybody that has a normal brokerage account as well. But they might not feel comfortable with it for a number of reasons. They might not know when to buy and sell. They might not trust Coinbase as a company just because they're not familiar with it, and they trust BlackRock or they trust Invesco because those are old names that they've already built trust and rapport with over years as an investor. But then you've got a bunch of cons with these marketplaces. They're open normal market hours. They're not open 24/7. So all these investors have to choose between a lot of these different nuances based on where their comfort are. Go ahead.
No, I just wanted to add though, the one pushback to that, and I fully agree with that from like a retail perspective. It's a convenience thing, but access is still very true for wealth. Like financial advisors, RIAs, wirehouses, private banks, like it's trillions of dollars of capital that just can't do this a different way.
Although I do see that on the come. We've seen some announcements from some of the bigger banks that they're going to allow their FAAs to invest their clients' money into digital assets in some way, shape, or form. So we'll see where that goes. I will also note that it's interesting. You know, I know there's probably some people from Coinbase here. Nothing against them. I love them. I have a Coinbase account. I use it sometimes, but the fees can be a little high, right? And the executions are not at a pretty wide spread sometimes. So there is that. The other thing, but it is easy to use. Whereas if you have a MetaMask wallet and you're trying to trade on a DEX, it takes a little while to get comfort with that, and not everybody's even going to attempt to do it. I understand. The other interesting thing is that if you have an FA account, you know, like at my Merrill Lynch account, you know, they give you little perks as you go up through the wealth stream. You know, however many assets you have on their platform. Well, if I have $1 million in digital assets and they're in my digital wallet, my self-custody wallet somewhere, Merrill Lynch doesn't see that, right? So it's not on their platform. They don't get money for that. But if I bought an exchange traded product, it would be in there, and I would get that. So, and then I can leverage it too, right? It becomes part of my leverage base in many cases too. So, but let's move on from that. So, sticking with the model portfolio, Francis, maybe from like a macro perspective, how do you see digital assets working in the modern day portfolio?
Yeah, so this is how I talk to clients. And I travel a lot and I talk to a lot of advisors all over the country. And it's interesting because I noticed yesterday listening to our panels that a lot of advisors across the country would not even understand half of the acronyms that were used yesterday. So there is a real disconnect in understanding. And when I look at it from a portfolio construction, I look at, you know, traditional things. We still have axles and wheels, right? We still base our economic and credit seasons on inflation and growth and policy, right? We look at Ray Dalio's all-weather portfolio. And then when we look at digital assets, they have to go somewhere in the construct. So in various economic seasons, you obviously have various sector performance, et cetera. And then it's a matter of looking at correlations and how they change. I think there is a great opportunity in some of the new products coming out. Particularly, we have a mutual friend, Matt Tuttle from Tuttle ETFs. He just released BEGs, and it has gold, silver, Bitcoin, and Ethereum, right? So they're taking care of the diversification around the various correlations across the economic seasons internally. And so I think that's more of an exciting conversation with advisors who, you say DAT 2.0 and they just look at you like, huh? And of course, that's in our everyday language. So when I look at portfolio construction, I look at that, I look at various economic seasons and, watch the technicals actually. Yeah.
Yeah, no, that's a good point. Just because it's not a traditional asset, stock or bond, doesn't mean that some of the traditional portfolio analysis tools don't apply. And one of the words you used actually was correlations, which I find incredibly interesting because there are some people out there in the investment world who say, oh, you should buy this or that digital asset, often Bitcoin, where they say, because it has no correlation with markets. And I'm like, I own a lot of Bitcoin. I don't really know about that. But Eric, maybe you can talk to us about what kind of correlations digital assets, not just Bitcoin, but digital assets in whole have with traditional markets, and how should investors be either using or avoiding those type of correlations?
So I just looked at it yesterday because you made me look at it. And over the last year, Bitcoin has become more correlated with the NASDAQ 100 index equities. ETH has become less correlated with the NASDAQ 100. Both have become negatively correlated over the last year with gold. So those are the three kind of options that I looked at. And it's just interesting to watch those patterns. So Bitcoin more correlated, ETH less correlated, and both less correlated to gold. So, it's just interesting just to kind of watch these trends.
Interesting. So when you think about that kind of correlation, would you be comfortable telling an investor, hey, this gives you some sort of diversification with respect to the correlations of the broader markets, or you'd say, no, you're swimming in the same pool?
I am an idiot. I don't and like I don't give financial advice at all. And my family loves me more than anything, and they always ask me, "Hey, should I buy this? Should I buy that?" And I'm like, I don't know. Like I know ETFs really, really well. I know how the market structure works really, really well, but I don't give financial advice ever.
Yeah, of course,
I
nothing
wanted
we're
to
saying up here is
comment on
financial.
that because we did a lot of research on the correlation among asset classes. I think really there are two variables you have to consider. One is your time horizon,
Yeah.
right? In the short term, again, you're talking about daily movement of one asset versus the other. Does it really matter to you, right? Unless you're a quant fund, obviously, right? The second dimension is what frequency are you using to calculate the correlation? There is well-established research saying Bitcoin and gold, obviously they are competing for the inflation hedge. In the short term, they are actually negative correlated, just as you observe, because certain people prefer gold over Bitcoin, but over longer term, again, they are positively correlated because they are both viewed as a potential inflation hedge.
Sure.
Yeah, Tony, can I just say something quickly? I'm taking it back to the global macro conversation. You historically look at the correlations between gold and the dollar, right? When you're talking about inflationary or deflationary cycles. And, those change with the economic seasons. When gold and the dollar are perfectly correlated, we're usually in a deflationary scenario. So when you extrapolate that and you think about the correlations of digital assets, under various timeframes and various conditions, that's where we start to have a conversation with advisors about where to insert those things. And correct, I mean, basically Bitcoin and the NASDAQ 100, like NVIDIA Bitcoin.
Right.
So, right. So then talking about it as a diversifier doesn't quite work out so well, but we look at it from that seasonal perspective.
Gotcha. Thanks. And that's helpful. And so the other thing that I think about when, if I was a financial advisor, and again, not financial advice for anybody here today, but if I was a financial advisor and I'm normally for a high net worth individual, I was managing this large portfolio of stocks, bonds, currencies, whatever it is, private investments, right? And then all of a sudden, my larger house says you are okay to start recommending digital assets into this portfolio. Fine, I'm willing to do that, and I get the whole economics behind it. But then when I actually go to do it and I start thinking about it more on a technical level, Rob, can you talk to us about some of the the data that goes into both in the creation of these assets, the management of these assets. I mean, it seems to me like I know in my own portfolio, when I'm looking across the spectrum, I'm getting different prices from places. I'm getting different marks. If my tax lots are a mess, people don't even tell me my tax lots. I'm trying to do it myself, but all of these things, the data flow that I get from these products is not the same that I'm getting from my stocks and bonds.
Yeah, it's a great question, and anyone that hasn't interacted in the crypto or digital asset industry might not be aware, but there's a huge advantage to this rather that causes this problem, which is the nature of fragmented markets, and how crypto has kind of over the last more than a decade created all these fragmented markets, and it creates a ton of great trading opportunities. ARB strategies, you can trade assets for one another. You can do it in fractional quantities instead of whole quantities. You're not buying and selling them for cash like you are on your brokerage account, traditional brokerage account. But all of that makes reporting, risk management, and all the due diligence and other decisions that particularly issuers of ETPs and other products need to address when they're creating these funds. And they're very tricky. You can go directly to a Coinbase or a Kraken or a centralized exchange and get it. A lot of people think all this data is on chain. It's not. Most of it that's needed is not on the blockchain. And so then you look at third-party vendors, data companies that can then aggregate it. And usually I'd say companies try to get the data their own first. Then they realize that that's kind of creating a whole business and it's hiring a lot more people than they want to. So then they go to a third party and a vendor and they partner with them like BlackRock has done, like Invesco has done, whether they're trying to figure out the calculation behind the rates that they're using, even for a spot asset, because just like you mentioned, Tony, Bitcoin has hundreds of prices across the world all at any given time. During normal market conditions for a big market cap asset like Bitcoin, they're pretty close. During abnormal conditions, they can get very far apart. I mean, 15% or more, even for an asset like Bitcoin. Anyway, these are a lot of the problems. There are solutions to them. It's a lot more complicated. Usually a lot more complicated than the consumer needs to get into. But anyone that's creating these financial products, absolutely. Institutions that are trading them usually go into due diligence more. I know there's a due diligence panel, I think, after this one. So I'd say the big takeaway is don't underestimate the data behind it. And there absolutely are solutions, but those solutions that's happening in the background are very, very different than how we solve for them traditionally.
Yeah, and I would say that, when the first ETPs got approved in the US, there was a lot of people, not unlike myself, more crypto native-ish, who said, why we're going in the wrong direction here. Like I'm putting it in this, institutional wrapper, but when I could have just traded the underlying spot thing itself, and I can trade that 24/7, whereas the ETP, I'm stuck on the exchange hours and things of that nature. But to your point, Rob, it makes those issues, those kind of data issues and the reporting issues go away. It puts me back in the traditional system. I get my 1099. I know it's right, or at least I believe it's right, and I move on with my life. So we have
1099 is not right.
but at least I can rely on it. But so so let's take a little turn. That's how what we just talked about is how we're using digital assets in model portfolio. There's some really good stuff to it, but there's also a bunch of risks. And so, Eric, I mean, when we start speaking about the very unique risks that are in digital assets, they do not exist at all in the traditional asset management world. So, like you read every day, there are hacks. They still happen. It's 2025. They still happen. The one thing I love about putting assets on chain, even real world assets, is the ability to use smart contracts, because then we have programmable money, programmable assets. It opens up a whole new world. It's awesome. But there's smart contract bugs. I mean, these things just happen. So, Eric, when you think about those things, how do you think about what the industry can do to protect investors, and maybe there's things investors can do to help themselves?
So when I look back at my career and investing, I started investing in '99. I opened up a Schwab account in 1999, right? So, but you don't question when you open up that account, where's my money, right? Like, yeah, you want the FDIC insurance, so on and so forth. In 2017, I opened up a Gemini account, and I was like, wait, they want my social security number? Wait, well, I'm not giving them my social security number, but you have to, right? Because that's where you're going to buy your digital assets. What I think investors still to this day in 2025 are asking, what's the custodial protections that I have at Coinbase, at Gemini, at Kraken, and not fully grasping that, right? Most traditional financial advisors don't question where their assets are custodied. Now you gotta, right? And you gotta think about that. And in particularly when FTX imploded, it caused a lot of fear in the marketplace. And I think it set us back at least 5 to 10 years of just traditional people understanding this marketplace and wanting to be part of it, right? Which I think we moved it. IBIT crushed it. I mean, absolutely crushed it and has made it much more easy for TradFi people to buy into it. And you don't question where BlackRock custodies this. You don't, right? Because it's BlackRock. It's the largest asset manager in the world. You don't mess with them, right? And you just trust them for who they are. And I think that's the differences. And, what can we do as an industry? We can push IBIT. We could push my product, which is a tenth of that. But I think at the end of the day, we need to be able to trust the custodians that actually house the crypto, right? And no keys, no protections, right? Like those are sort of the concepts that people need to fully grasp. And I think we are, right? And if you think about this, the first index-based mutual fund was born in 1975, 50 years ago, right? That was like the first new asset class that we've had access to until crypto, right? So it's new, it's nascent. My son, he's 22, he loves it. In and out on his Coinbase account, which meanwhile I have to tell my compliance department, Invesco, that my son is doing all this crap all the time, which is annoying. But anyhow, I mean, those are just some of the things that, like, you've got to take into account. Like, it's going to be generational. The way my father, he doesn't even know how to spell ETFs. But like that's just the way it works. And I think that's what's the next steps we're going at.
Yeah, and I would say for people who haven't opened up a self-custodied wallet and tried to trade, whether your actual trading is on a centralized exchange or a decentralized exchange, like you said, there's a lot of things to consider. Like, where's the custodian? What's the terms of use of this protocol that I'm using? By the way, most people, when you use the internet and you go to buy things on Amazon, no one reads that terms of use thing. They make you click the button that you did, but nobody actually reads it. Here, you'd actually really want to read it, right? You'd want to know what's going on. I will even tell you that the first terms of use of Coinbase custody, if you read it, I'm a lawyer, if you read it as a lawyer, it actually read that those assets basically got commingled and they were part of Coinbase, and Coinbase basically owned the assets. You did not. That's been fixed now, but still, I mean, these are the things that you have to be reading, and which, like you said, in the traditional finance world, or even digital assets that are held by a BlackRock or Invesco, that's been taken care of. Professionals have already done that reading. You don't have to read it, but if you happen to be out on your own, read the terms of use. So, Kelly, beyond these technical hurdles and things we should be watching out for, what are some of the other structural impediments that you see that prevents, whether it's individual investors or institutional investors, from coming into this market, and maybe what can we do to help that?
I think there's definitely still a lot of risk involved with digital asset, right? I think access, operational counterparty, those are being addressed, right, with credible issuers coming to the market. I'm actually more interested in the investment risk because obviously Bitcoin people still consider it as high volatility, although it's probably the lowest among other type of digital asset. The biggest risk currently is, as I mentioned, a lot of other digital asset other than Bitcoin is really a bet on emerging technology, right? But unlike equities, where you have a legal entity and the company is supposed to pass on revenues to the shareholders, in digital asset land, currently there is still no clear regulation on protocols that are actually generating revenue to pass on their revenue to token holders. And then probably some of you have heard of Clarity Act, which is really an effort in this new administration trying to actually give issuers a credible way of passing on the revenue to token holders through the definition of whether it's a commodity or a security. I think the whole industry is getting mature, right? And in the maturation process, the access issue and operational issue will first be addressed, but the investment risk is still being evaluated. It's a double-edged sword because on one hand, if you are not sure how to access or how to evaluate the risk, that means the risk has a premium attached to it, right? But eventually, with regulation coming in, with technology maturing, I view it more probably going to be very similar to the equity business.
It's interesting you talk about the maturity of the markets, and I can see it in the places that you play. But Rob, maybe you can talk to us about where you see the maturity of like on-chain assets, and maybe how did that compare to the exchange traded products? And also, one of the things that I love about the exchange trade, so I work for KPMG, so this is pitching my own game. I love about the exchange traded products is that they're audited, right? We audit a bunch of them actually. But like some on-chain products, they're not at all, and that's kind of the gig, right? They're just on-chain. So maybe you could just speak to like the differences, the values that come with those kinds of things.
Sure. And I know for those that aren't familiar, there's a lot of innovation going on in building financial products that relate to digital assets. Some of them are putting them in traditional products like ETPs, which is kind of ironic to me because you're putting very new technology in a very old product. But it couldn't have been more important for adoption. And I mean, you can look at all the prices. I mean, the amount of people that own Bitcoin in some form today because of those ETPs, I mean, has changed tremendously in the last couple of years. It was January 10th of 11th, right? And so, and now we're seeing more crypto products beyond, the initial Bitcoin and then Ether. We're seeing Ether and Solana, which are both stakeable assets. So that means not only do they appreciate in value, but you can get yield on them in the form of staking. But we haven't seen those in an ETP yet because we need the regulators to get comfortable with how to manage risk around the staking as well. But hopefully there's light at the end of the tunnel here. I think December 16th is the new deadline. Anyway,
technically 2 snuck out, and I'll leave it at that.
Which I just learned that today. But to get back to your question, Tony, so you've got these 2 different directions that they can go in. When it comes to on-chain, truly on-chain, so you're going into a decentralized marketplace and you're buying a fund, usually it would be a traditional asset there. There's a long ways for those to go for a number of reasons. I mean, we haven't figured out how to regulate them. We haven't figured out how to do the reporting. All of the operational risk management that's required to assess the smart contracts that facilitate all of this. It's a very technical exercise, and there's not a lot of companies that do it correctly, in my opinion. It's still very much evolving. So because of that, we can get them in these traditional wrappers that I consider to be fairly low risk today through, BlackRocks or Invescos and so on traditional marketplaces. But that's a today story. I do think long term, but when I say long term, I mean 5-10 years, in my opinion, is when we'll see more material products truly on chain. So.
Yeah, and so when the on-chain native products, I really love just because of the innovation, the speed, the programmability, the composability, all great stuff. But I will say, even in my shop at KPMG, we wrestle with DeFi every day because it doesn't follow the same rules as everything else. It doesn't have any of the protections as everything else. And so the data extraction's harder. It's just hard to deal with, but we all need to get there. So that is something that we at KPMG, we work on a daily basis. But let's go back, Francis, you were talking about it from a macro level before, so let's stick on that for a second, because one of the things, when we start talking about risks of this space, I think one of the things that I find risky is investor perception, because, unless you're in it all day, every day, all you hear is what you read in paper. Nobody reads a paper anymore, it's online. But what you read online, and, so what we hear is, especially if you're on Twitter, well, Bitcoin, that's digital gold. It's a safe haven asset kind of thing. It's a store of value. I don't know. So you can totally see an investor becoming maybe somewhat complacent as something's a less risky asset when it's really more risky. But then likewise, when you go online, when you go on chain, you want to do transactions, you need to move value around. Stablecoin is the way to do that. And people just think, well, stablecoin's a stablecoin. After Genius Act, obviously that's not true, but that's not what people think. And they don't even think about stablecoin anymore, which is ironic to me. They actually just think of it as cash. And so maybe you could just speak to like investor perception. Is it right? Is it wrong? Where are we trying to go with it? Does it help or hurt?
Right. So taking it back to the beginning of Bitcoin and the beginning of digital assets, right? It was a rebellion against central banking. It was a rebellion against fiat. It was a rebellion against debt, right? And through these various frameworks and the clarifications and the political momentum that John mentioned yesterday, basically stablecoins are tokenized dollars and they are fiat. And when you look at gold, and you look at the history of gold, you look at 1933, you look at 1971, the whole idea around a currency that's backed by gold is it has a limited supply. And that's why Nixon took us off the gold standard in 1971. And the whole thing mechanically behind fiat is that it has an unlimited supply. And then when you look at the mandates of central banks vis-a-vis, inflation and growth, money supply juxtaposed to GDP, you're seeing these mechanics because basically we inflate our way out of things until we can't anymore. And when you then look at the correlations between gold and the S&P 500 and Bitcoin and the S&P 500 or the NDX, you really start to see a bit of a different conversation. If Bitcoin were going to replace gold, gold would not be making new all-time highs consistently. And we don't know if the top is in. We've got some lower highs. But for this particular season, as growth sort of reignites, and Nouriel went over that yesterday. So the thing about it is that when I approach clients, when I approach advisors, basically digital assets have become, through the Genius Act and the stablecoins, an extension of fiat. Bitcoin mechanically in and of itself has a limited supply. So that's never going to replace fiat because there's no way the Fed can enact its dual mandate through that vehicle. So then you've had this broaden out into these various derivatives and various regulatory scenarios that just basically reverts it back into fiat because you're not going to unmock, 100 years of central banking loss. So it's not the same as gold. It doesn't have a perfect correlation. They have different risks. Gold does not have a flash crash risk, which we just saw recently on October 10th, right? There's still some need for infrastructure. And then again, to circle back to some of the other points made on the panel, it is a generational conversation. My friend was here last night, wealthy guy, Emmy Award winning writer. I said, how much Bitcoin do you have? $8,000, right? It's just generationally, he's not there. So, the bulk of the assets are still the boomers. We're going to have this great transfer of wealth. And I think digital assets are, as they fall more in line with the existing infrastructure of the existing system, I think in the future, you will have a conversation of how it kind of, it'll become dollars at some point, but we're just not there yet.
Well, I want to add, we can debate all day on what is true money, right? I actually view stablecoin as a way to bring all the fiat money on chain. And once they're on chain, they have a lot more choices, right? So you just mentioned currently traditional finance is trying to put digital asset, which is a new thing, into the traditional wrapper, whether it's an ETF or hedge fund. But there's a parallel line that's being developed, which is on chain. People heard about tokenization technology, no problem. You can bring this anything on chain, right? Like my jacket, you can put it on chain too. So basically, I think stablecoin is really the first step to build a bridge between the vast amount of money you all have, which is off chain, to on chain. And with development and maturation of the asset classes, I'm actually very optimistic on more choices for people to have once the money is moved on chain.
That's exactly how we describe it too. It's like they're inverse direction bridges. Like where the ETFs are bringing a crypto asset to traditional investors, tokenization, stable coins are just going in the other direction, bringing traditional TradFi assets to crypto investors on chain.
Yeah, and I would say that the whole wave of real world asset tokenization, that's the thing that for years at KPMG, because we do have a lot of boomers, and I tell them, I'm one, I guess, but I've been telling them for years that whether you believe in crypto as a long-term thing or not, it may or may not be here in 10 years. You still got to get comfortable with this because everything you trade, whether it's stock, commodity, bond, they're all going to be traded on a blockchain. Right? It's faster, easier, and quicker. You may not even know it's on a blockchain, but it will be. So you just have to be comfortable with the concept and you got to get used to this. So, and by the way, you mentioned a boomer with $8,000 in Bitcoin. That's a lot greater than zero. So kudos to him.
He's very progressive.
So sticking with that, let's go, Matt. Where you are at BlackRock, you have the privilege of having a very wide, diverse set of investors. Everything from like huge scale institutional investors to me. I actually am an investor. So what do you see? I wonder if there's differences between the institutional investors and the retail set of investors with respect to what risks they see, what they perceive, and what opportunities they perceive.
Yeah, I think it's a really interesting asset class, one, just because, and if anyone has a different example of this, I would love to know. I don't know of any other asset class that like went entirely from retail to wealth and then institutions in that direction, where things always go in the other direction historically. So one, I think that's just like an interesting point to flag. I think though the investment case is actually surprisingly similar. We can certainly debate the correlations because like correlations, like Bitcoin doesn't look like gold from a trading perspective, but like the fundamental qualities like actually really do. And there's been a lot of idiosyncratic things that have been driving Bitcoin the last couple of years, things like the election, things like expanding access to wealth via ETPs. And so I think most of our investors are thinking about this as an asset that's truly scarce, can make long-term credible commitments about its scarcity, which fiat money can just simply not do. And in a world of sort of de-dollarization and excessive debt levels, like that's a story for most investors, whether they're retail, whether they're institutional, or I should say really anyone who's directional. There's a large pocket of investors who are just trading this tactically. Probably a lot of folks in this audience, the hedge funds that are trading basis and using the ETPs as the long leg to collateralize a short futures position. But for the folks that are directional, they're generally thinking about this as a de-dollarization, long-term scarcity trade. Now, with that said, where are the differences in sort of the approach between them? And this is where I always find a little bit interesting. Like our internal think tank came out and said, we think 1 to 2% is like a good Bitcoin allocation for most investors who want to have that profile in their portfolio. In reality, I've seen like a much more, what I would say is like a bimodal distribution of sizes. And I'm speaking very clearly about folks who have invested. Like the majority of wealth and traditional investors are still on zero, but of the ones that have invested, I actually find like, well, direct investors can be extremely large sometimes. You'll find the direct investor who it's their entire portfolio. But speaking between like wealth and institutional, we typically see wealth on the higher end of our range, like above the top bound of our range. Typically, I would say 3-4%. I feel like a lot of them feel like they've done a lot of work and they don't want to do all that work to get to that point and put in 1%, which they feel like doesn't have a material impact on their portfolio. And then simultaneously on the other end of the spectrum, most institutions I've seen are less than 1%. I've seen they're substantially more portfolio construction focused, thinking about time varying correlations, trying to come to terms about how it fits in a portfolio context and overall portfolio efficiency improvements. But oftentimes you'll even see it, like like Rick Reeder, who runs multiple trillions of dollars for BlackRock, has had Bitcoin in his portfolios, multiple portfolios, in some cases fixed income denominated portfolios. And that's just because they think of it as a truly scarce asset that's going to improve portfolio Sharpe ratio, but being fully aware of volatility constrained, like it just can't be more than a 30 basis point position in those types of books. Notably, they've actually just extended to ETH too in those portfolios. I think that was public yesterday. But also, again, just very small basis point positions, thinking about Sharpe optimizations, thinking about portfolio improvement with very vol constrained mandates. And so that's generally the theme I see is more portfolio construction focus, smaller position sizes.
Awesome. Well, yesterday was a bad day to go long ETH. Not performing well today. But anyway, that's one day. Don't worry about that.
Public yesterday, a few months ago.
It'll come back. So we have a few minutes left. Let's do this. I'd like to use the last time that we have for like a little bit of a lightning round. Maybe I could ask each of you, starting with you, Eric, and we'll go down. Just point out the one thing that you're really looking for this year, looking to happen, looking to get a hold of in your portfolio, whatever it is, that you think is going to be substantive in what you do for a living with respect to digital assets this year?
So this year, we filed for Solana with staking, waiting for the government to open up. We're not going the backdoor route like some of my competitors have gone. And that's it for 2025. 2026, I will just quickly state, and we briefly talked about this on the panel, but tokenization is real and it's coming. And the train is leaving the station as we speak. So I think we as asset managers are all, trying to figure what that looks like. But that's definitely coming anytime soon.
Yeah, and by this year, I do mean the next 12 months. So that's
Fair
that's
enough,
a good,
fair
that's a
enough.
good. And by the way, the staking in the ETFs, the reason that that's so important, and it's not just in the ETFs, it's with every portfolio, is most digital assets, if you just leave them in your wallet or in your account, they're not income producing. And so you have to affirmatively do something to make them income producing. That's a whole other part of the financial picture.
Correct.
So, Kelly?
I actually like to see more awareness from the mainstream on the fixed income part of crypto. Because people think of crypto, they think it's risky asset, I don't want to own it. But if I tell you there is a fixed income market in crypto where you can earn a yield which is similar or higher than private credit, which everybody loves, in crypto you can get that, maybe even with less risk. I mean, again, risk is all relative. And this is where crypto can actually generate a lot of good opportunities. So I don't have time to expand, but think about DeFi and all the challenges. I'm really looking forward, including the family office I manage, right? Introducing institutional quality asset management that can bring juicy crypto yield to mainstream investors.
Yeah, that's a great point. I think people don't understand that on chain, I don't have the JP Morgans of the world just yet. So I don't have billion-dollar balance sheets floating around, people lending all over the place. So it's a little more scarce, the lending. And so obviously the rates are higher. But yeah, similar market.
I was going to say the same as Eric, the staking. So I'll change mine, and I'd say a concrete regulatory framework from the SEC is a big one. I know they're working on it, but I think we're all waiting to see it.
Well, from your mouth to God's ears. I hear that the government's going to reopen next week, but we don't know. We don't know who to, but that is high on the list. We'll get a market structure bill. It's not going to solve all our problems, but as the markets love to say, clarity is the road to higher prices, right? Without it, we can't grow. So, Francis, what are you looking for?
Yeah, so on the technical side, basically, I'm looking at why we didn't really have a recession, a meaningful recession post the Fed raising rates and keeping them high. Basically, you had a record amount of fiscal spending. You had a lot of private credit that, sort of made up for the, commercial and industrial loans when they fell. And then you had, a record amount of credit issued via credit cards with huge interest rates as well. So we have a bifurcated economy. 60% of our, citizens are living paycheck to paycheck and paying 30% on their credit cards in addition to whatever they're paying at the grocery store. So that is one shoe that, there is some risk with consumer fatigue. So just looking at the technicals of it, we have a record amount of liquidity in the system right now. So when people are like, hey, are you bearish because of all these crazy risks? As long as the M2 is making a new high all the time, that's heavily correlated with the S&P 500. And then you can extrapolate those correlations that we discussed with digital assets. From the client-facing perspective, I just think that talking about, how you just dip your toe in and where we're heading with tokenization and looking at things like Jamie Dimon says, like everything's going to be tokenized. And so you kind of have this conversation about how you're responsibly introducing them to this and you're looking at it in this very technical fashion. And so that's
And Matt?
Yeah, I think mine's kind of an extension of that. It's just everybody sees the headline success of the ETPs and how much money was raised. I don't think people realize behind the picture, there's still so many barriers placed on these things to access inside of large firms. I would say the most noticeable example of that is the big banks. And so I think from my seat, having those conversations, you're seeing very meaningful acceleration. And there was a little bit of a disappointing pause, I would say, at the beginning of this year. And now you just have an extremely meaningful acceleration of that, where you have the second large wirehouse bank start to enable not just my clients can come to me and trade this on an execution only basis, but like you can go out and solicit this. Your discretionary portfolio managers can put this in an asset allocation. Like we're just removing the roadblocks and all the rules and policies internally at these massive banks to enable access. And I think those are like the single highest leverage points from like an access perspective, where there's truly like one investment committee that controls 20,000 advisors and $1 trillion+ dollars. And so those are turning. Like we had another big one last week. The first approval for ETH at the first wirehouse bank just this week as well. And I'd say you have like 2 or 3 more of the largest ones that are almost certainly going to come this year. And so I think that's just like a really compelling story behind the scenes that folks aren't totally in tune on.
Awesome. Well, we're just about out of time. So I just want to thank our panelists for all their great insights today. Thank you.
Thank you.